Well, hello, everyone. As we transition over to our presentations today, we're just so delighted to have you joining us. My name is Emily Young. I'm the Executive Director of the Nonprofit Institute, and we're very excited to have you with us today. We're really talking about this year and some of the unique opportunities there are for encouraging charitable giving in light of recent tax provisions. And we're so delighted to have our speakers, Anna Diaz and John Kraemer, with us, who will be sharing from their amazing expertise what these opportunities look like. And some of them may not last. And I know they're also tracking that in Congress right now. So with that, I'm Emily Young with the Nonprofit Institute at the University of San Diego. And for those of you who joined while I was speaking, if you could share, if you haven't already, what most interests you in terms of what you'd like to learn today from our speakers. And what we're going to do is track that in the chat, and we'll also be tracking questions that might come up for you as we go through the presentations. Next slide, Cynthia. And we're very excited to co-host this webinar today with our wonderful colleagues at the Gumpert Foundation, the mission of which is to serve and inspire. And you can see the co-directors and trustees listed on the screen there, Patrick Dempsey and David Cornsweet, if you'd like to learn more about the Gumpert Foundation. Next slide, please. The Nonprofit Institute has a three-part mission to develop the next generation of high-impact transformational leaders, as well as to build a community of strong organizations in nonprofits and philanthropy, and working in service of our communities for working towards social good, and of course, delivering high-impact research on the nonprofit and philanthropic sector, as well as our quality of life. Next slide, please. And with that in mind, I just wanted to share a sneak peek at webinars that we do have upcoming at the end of October, as well as into November. We'll be releasing our latest State of Nonprofits and Philanthropy report. And with that report, we'll be sharing not only what the nonprofit sector looks like today, but also, its relative financial health in light of the ongoing pandemic and economic upheaval and other things that have happened over the last 18 months. We'll also be sharing what we're hearing from nonprofit leaders. And one of the many findings that I wanted to share with you today is that in our latest nonprofit leader survey, we heard that 61% of nonprofit leaders expressed an increase in demand for services, but many of these organizations are still operating at reduced capacity. In fact, nearly half of the nonprofit leaders that we surveyed reported that they're still operating at reduced capacity a full 18 months in to the pandemic. Next. And last but not least, I just wanted to share that today is the University of San Diego's Giving Tuesday. And we'd love to have you join in supporting the Nonprofit Institute. We have a unique challenge from a donor right now. And Kim Fields will post in the chat if you'd like to support the Icon Fleeter Challenge. It will help the Nonprofit Institute help our nonprofit sector in serving the San Diego region and elsewhere. And next. And now, without further ado, I'm just so excited to welcome our two speakers today. And we have, of course, Anna Diaz from Dowling and Yahnke Wealth Advisors and John Kraemer from WealthPoint LLC. And Anna Diaz is going to kick this off. Anna is the lead advisory and principal at Dowling and Yahnke, and she began, lead advisor and principal at Dowling and Yahnke. And Anna began her career in the private banking and wealth management industry in 1997. So she has well over 2 decades of experience in this arena. Prior to joining Dowling and Yahnke, Anna was senior vice president and private client advisor at a national private wealth advisory institution for 16 years. She holds the Certified Financial Planner certified private wealth advisor, and certified exit planning advisor designations. Anna also holds a certificate in investment strategies and portfolio management from Wharton. And Anna completed her undergraduate work in financial services at San Diego State University. John Kraemer is a partner at WealthPoint, a leading provider of business and life insurance advisory services with a focus on succession, exit, and wealth transfer planning to entrepreneurial family groups and affluent clients throughout the United States. John holds a certified specialist in plan giving designation and brings over 30 years of experience in family wealth governance, business management, and financial services. John's philosophy of working with clients is to listen first, provide value through the planning and implementation process, and customize his approach to suit each unique scenario he's encountered. And with that, I know, Anna, you're going to be kicking off today's webinar, so I'll turn the floor over to you.
Great. Hope y'all can hear me well. Thank you so much, Emily, and thanks to all of you for joining us today. Great to have this conversation, and those chat questions were fantastic because we are entering kind of that giving time where donors are contemplating what do they want to give. Tax laws have changed, and we'll talk about that in today's conversation, and they're also proposed to continue to change. So that will absolutely influence the way individuals give. So great to have you all here. And as Emily mentioned, please send additional questions as John and I are speaking in the chat. The Nonprofit Institute team will be tracking those, and we'll make sure to answer them at the end of today's conversation. Okay, so let's dig into the agenda. So here's what we'll be covering today in today's talk. We're going to be covering first some of the questions that we're observing donors are asking, and you have a good pulse on this in the audience, but here's what we're seeing and wanted to share that with you. What you need to know about the CARES Act, which was an important tax law. A lot of the questions in the chat were current tax laws. This is a very relevant tax law that had some very particular charitable provisions, so we'll cover those. And then there are some current proposals right now that are very specific that could very much influence charitable giving. So we'll talk about that. We'll talk about the related giving strategies in that context. And then we'll go through QCDs, RMDs, Roths, are all these acronyms that are out there that your donors have and are thinking about, but are important to think about from a planning perspective. And then we'll go through some summary of the information and resources and absolutely a Q&A session. So let's dig in. So what are questions that our donors are asking today? And here are a couple of them, and these might not surprise many in the audience, but which of my assets are best to give? As we all know, cash tends to still be a major giver, and frankly, there are a major choice of giving asset, and there are tax laws that actually make this quite advantageous. We'll talk about in just a minute, but there are other assets. People give appreciated securities, people give business interests, they give real estate, and they're thinking about these things. Should I give now or next year in my will? That's a main question that's happening a lot, and why we commonly see that right now is income taxes have increased, and they're currently proposed to continue to increase, which would argue I might want to get more benefit now during my life than after life. And also many donors are just point blank saying, I want to see the impact of my giving. So we are seeing that as well. How can I give in the smartest, most tax advantage way? As you can imagine, this is very much top of mind for many individuals. Taxes don't drive all giving. We know that from the data, but they do influence how people give. And based on some of these strategies, we think it actually can amplify giving. So we'll talk about that in today's conversation. Can I give to charity and still provide for my family? This is probably one of the most important questions I see that isn't explicitly asked by a donor. What tends to happen is these donors are really giving and during their lives doing many things and kind of have toyed with the idea, gosh, I'd love to give more, but can I? Can I afford to do so? And it may seem obvious to a third party that someone can, but really going through that analysis is really important. And that's where those important advisors around the table helps in these conversations. And the last question is, I planned on giving, I've made a commitment for a number of years. Is there any reason why I would accelerate it and do it sooner? And there are certain reasons that might be a yes answer, and we'll talk about those provisions a little bit. So now let's get into a little bit of insight into the CARES Act. So if you all remember COVID, the beginning of COVID, one of the largest stimulus ever passed in direct response to the pandemic. It was a whopping 300-page document that all advisors, John and myself, all the advisors in our field were digging through, trying to understand very quickly. And we're really just going to focus on one important provision in today's talk, and that is the giving of cash. There was a very specific provision that said, hey, we really want to support nonprofits. And the way we're going to do that is by amplifying the ability to deduct more of a cash gift. So right now, the CARES Act says you have 100% of AGI deduction on cash gifts. What does that mean? So adjusted gross income is a number that appears on every donor's individual tax return. And that drives how much can be deducted of their charitable gift. Prior to this law, people were limited to 60% of that income. So if their income was here and they give, they could only deduct up to 60% of that. Now they're saying you can do up to 100% of adjusted gross income, which is really quite powerful. So now tax advisors, which are a really important part of this conversation, advisors like myself and John and others, are working with donors to say, does it make sense to give cash instead of other assets? So now let's talk about other assets. So appreciated securities or appreciated assets were another type of gifting strategy that people employed. And what that is, what is an appreciated asset? Appreciated asset is an investment of some sort that has grown in value, but if you have yet to sell it. So there's kind of an embedded tax consequence. If you use those types of assets to give, there's a 30% limitation. So remember I did that 100% and 60. Well, there's now a 30% limitation on those types of securities. Now, if someone's giving level, it never even hits that threshold, it may not make a difference. But now we're finding many individuals, when you run this calculation with their advisors, it can make sense to give cash over these appreciated securities. There are some nuance to this, and I'll be honest, as I've worked with a lot of different clients as they plan their giving this year, I have every answer under the sun. I've had scenarios where cash makes sense, where gift or securities make sense, where a combination of both makes sense. So it does require some really careful coordination with advisors, but as we speak to donors, just make sure they're thinking about, hey, there's a couple ways that it might be more advantageous to you to fund your gift. Please consult your tax advisors, of course, in full disclosure of going through this. So now that we know some of the key provisions of the CARES Act, now we're going to accelerate to today. And so in September, there was a proposal by the Buildback Better Act, which I determined I'm not going to have to say twice because I don't think I could say that act twice, but it was released by the House Ways and Means in September, and it includes some hints of what could be put into law. Now, keep in mind, these things have not happened yet, but we are seeing a fair amount of traction of these provisions, so they have a higher probability than we've seen in the past. We want to walk you through some details because it does influence charitable giving opportunities. So the first, the top ordinary income tax bracket is increasing to 39.6, and that highest income level is being hit at lower income levels than it was before. So with that being said, what that generally means is that my charitable deduction is more valuable when tax rates are higher. That's what that means. And so it's important to think about that as individuals are thinking through their planning for both this year and going forward on their charitable giving. Corporate tax rates are increasing, which is good to know, 26.5. There is a reduction in the estate and gift tax exemption from 11.7 to approximately 6 million. Quickly, what that gift tax exemption is, it's basically, think of it like a coupon that every individual is given, that they can give that amount to their beneficiaries free of estate tax. So my husband and I, Brian, we could each give 11.7 times 2 to people that we want. Well, that's now coming down to $12 million if me and my husband were doing that. And as now individuals think about that, they're saying, gosh, I do not want to have my wealth taxed at estate tax rates. We're talking 40%. So I know I'm in knee deep in a lot of families right now who are gifting now because these proposed changes are supposed to start in January. This is not in law yet, so please keep that in mind. But individuals who said, I always thought I was going to gift, but now this tax law is forcing me to really think about it, I have to make some tough decisions. They're doing this now. And so why that's important is it's forcing individuals to say, if I'm not giving individuals, charitable giving can be really helpful during my life and at death, which is planned giving. Roth conversion limitations are going to be put in place for high income earners. That's proposed. That does have a delayed start time, just so you all know. I think it's 2032 when that's supposed to take place. But why that's important is because IRAs, and I think someone asked in the chat, IRAs are a really helpful giving vehicle. Because if someone inherits an IRA, a two-legged person, not a nonprofit, they're going to pay income tax and possibly estate tax, depending upon the wealth level. So many people like to convert to Roths, which are tax-free vehicles. Now, if they're going to limit them, that means more people are going to end up with more IRA money than they probably wanted to. So if that's the case, that amplifies the value of IRA assets for the benefit of charitable entities and qualified charitable distributions, which we'll talk about. John will talk about a little bit later. Long-term capital gains rates are increasing to 25%, and that's for married filing jointly earners over 450,000. So again, showing the increase in tax rates, and there'll be forced distributions from retirement plans greater than 10 million. That goes back a little bit to my statement about Roths, is that means more taxable income is going to be pushed to individuals, high net worth individuals that don't want it. And so if they don't want to be taxed on that, that is a fantastic vehicle to consider for charitable giving. So now we've talked high level, we've talked about the CARES Act, we talked about the current proposals. Now let's talk about some of the shifts in planning that donors are thinking about today. So I mentioned that the exemption is coming down. And I just had a conversation the other day with a client who said, okay, I have to make this decision. I think I'm going to gift 3 million to my son, 3 million to my daughter. But now it's forcing the question, gosh, how much is too much for my kids? Which are really important questions to pose. And those come back to legacy and values that, conversations we dig in with clients. But also what surfaced from that is charitable intent, is that if I'm concerned about a certain level of wealth going to children, that's where philanthropy fits in, and a great opportunity to be having this conversation. Also, individuals are giving more during lifetime. And the reason why is because as different individuals have wealth, have different types of income and different types of assets, income tax can be viewed more painfully, almost, it's more pain than estate tax. As a reason for that, that means tax that we're paying year by year. Or, gosh, I want to do more now. I want to do more to have the tax deduction, but also see the impact of my giving. So a way to think about this is there are two kind of high groupings of assets that we're going to walk through, and John will dig deeper into this, but there are two high groupings of assets that people bucket in their minds when they think about giving. One is what we call non-qualified assets, or let's call them taxable assets. This is it could be my home, it could be my investments, it could be business interests that I have. And the reason why they're called non-qualified or taxable assets is that I've already paid the majority of the tax on those. And then when I pass, in theory, that there's a step up in basis, there isn't an income tax obligation with those assets generally. So those type of assets can be very helpful for, I'm going to say, two-legged beneficiaries, for people and their children and the people they care about. Now let's compare that to the other grouping, and these are just a good way to segment this as we speak to donors. These are qualified assets. Someone asked in the chat about IRAs and things. This falls into that category. These are assets that have yet to be taxed. They were tax deferred. So that means they have an income tax liability with them. And those, because those are not as advantageous to be given to two-legged individuals, it can be very helpful that they're given to philanthropy. And these are the types of assets that donors are contemplating shifting to philanthropic beneficiaries. So now, John, I'm going to pass it to John. John's going to dig a little bit deeper now into what are the best assets to gift. John, you're muted if you want to unmute.
That will help. Thank you, Anna. Very good. And wanted to say hello to everyone out there on the Zoom. And part of the purpose of today was really to help you feel empowered to start having conversations, to not feel alone. There's resources there to help you, and that we are a part of that team. And there's many people here in San Diego that can help nonprofits as they start talking to their donors. You provide so much in the way of inspiration to your donors, but it's also a wonderful strategy to just understand some basics so that you can start to have discussions with them, not as an expert, but someone to encourage, to welcome their gift, and to encourage them to talk to their advisors and to try to move it forward. There's great power in that. So as donors may approach you and you talk to people about giving, there's, again, different categories that might help keep things straight. So oftentimes individuals and donors, when they start to look at what they can give, they may have non-income producing assets. It could be a second home, a vacation home, a ranch, a farm. They could have short-term bonds, CDs. Sometimes these assets don't give them much in the way of income. So it's not very painful from a cash flow perspective to give them away. If they're keeping things for a rainy day, and then over time, they accumulate more assets, sometimes these are very easy assets to give, and just helping donors realize that it's not just cash. Although this year, cash is very advantageous for them, but there may be other assets in their cupboards. So cleaning out the cupboards and figuring out what else might be there. Another asset that's really good to give this year is high basis assets. This might be stock that they have where it hasn't gone up a lot in value. Might be an annuity plan they started for retirement and now realize they don't need it for retirement, and it hasn't increased greatly in value. Some people have life insurance plans that they've had in place for many years, and there's a large amount of cash built up in them. And then finally, inherited assets, where you've received a step up in basis at the time you receive this asset. And again, it hasn't gone up significantly. These assets can be turned into cash and gifted this year and get some of the benefits that Anna's been talking about and that I'll describe in more detail. Money for cash gifts this year can come from different places. It doesn't just have to come out of your accounts. Corporations under the CARES Act also had a tremendous ability to increase the amount of giving they could do. Typically, they're limited to 10% of their net earnings, but this year they're able to do 25%. So many corporations actually have money in the companies. They're taxed taking it out and distributing it to the owners, but there can be a significant tax benefit by having the corporation gift directly to the charities. And this is something that a lot of people don't realize is available to corporations to gift to nonprofits. Also, this won't generate any tax savings if you're giving, there are tax savings when you gift, and the deduction will be generated to the corporation. For private foundations and donor advised funds, many people have already made transfers to their foundations to donor advised funds, and those funds can be used this year for charitable giving. It can be a source of providing benefits to nonprofits at a time when it's really, really important. I think we all recognize the stress that so many families and our people in our community have been under for the last 18 months. And it's a tremendous time to actually free up some of those funds that are in the private foundations and donor advised funds. So keep all of that in mind. And that's part of what Anna said, is reaching out to the advisors can help with all of that. Next slide, Anna. So one of the easy ways to give is from someone's IRA. A lot of times, higher net worth individuals that have saved a lot of money over time and they've been good savers and have lived within their means, they've built up the money in their IRA and they've never used it as they start to approach age 70 and a half. And now they're almost dreading their first distribution from their IRA. They're usually not very excited. They're concerned about the tax they're going to have to pay. As Anna said, this money's grown tax deferred, and all of a sudden it's going to be taxed when it comes out of the IRA. And what happens is, as that money comes out, it's taxed at an ordinary income rate, which oftentimes for someone in a higher tax bracket can get you into the highest tax bracket very quickly. So there's an interesting provision. You can make a gift from your qualified plan, from your IRA, directly to a nonprofit, and it doesn't increase your income for the year. You don't generate a deduction. So in effect, it's tax neutral, but it does satisfy any required minimum distributions you have. And you can start making these qualified charitable distributions from an IRA once you reach age 70 and a half. And it's quite a high limit. You can go up to $100,000 per person. And if your spouse has an IRA as well, they can also go up to 100,000. Now, not everybody does that much. Some people just make their required minimum distribution transfer and call that enough. But we have seen a number of individuals give the full amount every year until their IRA is emptied. If this is something they're not going to use themselves, it makes more sense to give money from the IRA, since you don't have to pay tax on it, than to take a distribution yourself and then contribute that to charity. So it's an easy asset to get to. There's some key things to remember. This distribution has to go directly to the public charity. So you can't take the money out and then send it to charity. You have to work with your investment advisor, and they will assist you either with a transfer or with a checking account so that a check can be sent directly to the nonprofit. And remember, there's no taxable income, but there's also no deduction for this. And you can't make these gifts to private foundations or to donor advised funds. They don't qualify. And there was a question in the chat, does the CARES Act gifts qualify if they're going to a donor advised fund? And that answer is no. These provisions of the qualified charitable distribution, the QCD, and the provisions of the 100% of AGI deduction, those only apply to public charities. And the charity will provide, and you must remind them to provide you an acknowledgement, because you'll need that for your tax return. The next slide, Anna. So the QCDs are a great way to give. And for those that have large IRAs that are not utilizing them, it can be a great vehicle for giving during lifetime. Anna, could you move to the next slide, please?
Sure. Do you see Roth?
Oh, not quite yet. Maybe it's delayed.
I am going to share. Bear with me just a second.
So now we're going to talk about Roth conversions. For those individuals that have large IRAs and maybe aren't interested in transfer them to charity, there's a very interesting provision in the tax code that lets somebody take an IRA that's taxable today, and if they're willing to pay tax on it and make a distribution, they get rewarded. And they get rewarded by that transfer to a new IRA called a Roth IRA, allows any funds that are in that Roth to grow tax deferred indefinitely until the end of lifetime, and then for an additional 10 years after the end of their lifetime. And it's called a Roth conversion. So you convert a traditional IRA into a Roth IRA. So you're going from a tax deferred, but tax being owed someday in your IRA. You're paying the tax now, but you're growing that money in your Roth IRA, and it grows tax-free, and you can take the distributions from your IRA tax-free. So it's a very advantageous asset transfer to do for an individual that doesn't need their IRA, or if they want to pass a valuable vehicle onto their kids. The only issue is you owe a tax when you take that money out. So this is a technique we talk about for somebody that does want to make a large gift before year end. They can also explore using the tax savings from the gift to offset the tax that they would create on setting up this Roth IRA. But the beauty of the Roth is it's no longer subject to income tax. It helps you grow money quicker in the future, and it can be a very advantageous tool to combine with a charitable gift, matching the two together so that you don't have tax this year. The Roth IRA is subject to gift and estate tax, just like a traditional IRA, but it's a very income tax efficient asset to leave the heirs, whereas a traditional IRA is one of the least tax efficient assets to leave to heirs. So the rule of thumb we use is If you want to benefit charity, one of the assets you can look to first is your qualified or your retirement plans, because as Anna said, there's been no tax paid on those over your lifetime, and there is no step up in basis at your death. So combining this, Roth IRA can help you mitigate both current and future income taxes. And this is the unique year to explore this because of this CARES Act only being in place during 2021, that the deduction for cash gifts this year can be used against 100% of your adjusted gross income. So the gifts can be structured to match exactly what you want. You can really control how much tax you pay, how much of a gift you're making, and then what the size of your conversion is going to be. And the larger the gift, the larger the Roth conversion that can be made for your family. And it's really incredible. The other avenue we've seen this work is if someone is contemplating leaving money to charity in their will or through their trust at the end of their lifetimes, this is a great time to meet with your advisors, talk to your wealth managers, someone like Anna, and have them show you the numbers. Because if you can accelerate a gift that you are going to make at the end of your lifetime and give it today, it can enable you to set up one of these Roth IRAs. So it really is a way to benefit charity and benefit your family if you have more assets than you need to live on yourself. These Roth conversions can also be paired with a charitable lead annuity trust. And it's just one of these tools that people oftentimes think of philanthropy as giving money away. But because the tax benefits are so significant, there is a way to do the planning to benefit charity and your family today. Somebody asked earlier a question in the chat, what's the difference between giving at death and giving during lifetime? And as Anna said, if you make a gift in your will, that gift isn't going to be subject to a state tax, but you don't receive any income tax benefits. If you make that same gift while you're alive, you'll get a current income tax deduction. And those deductions in California, if you're in the highest bracket, are worth more than 50 cents on the dollar. So if someone was going to leave $1 million to charity in their will, no estate tax, but no income tax benefit. If they make that gift during their lifetime, they get $1 million tax deduction, which will save them in a high tax bracket over $500,000 in taxes. And you can use that and pair that to do the Roth conversion while you're alive, and leave a benefit for a spouse and for your children, because they'll now have an asset that will generate income for them tax-free in the future. So Anna, yeah, next slide, thank you. So in summary, we've covered a lot of territory in a short period of time. And I think the bottom line is not that anyone on the call needs to be an expert, but we just want you to feel empowered. You'll be able to get a copy of the slides. You'll have some resources that we'll talk about, but we just wanted to summarize for you some of the things to think about before year end. This was what a number of you had said in the poll is of interest. So cash gifts to your favorite nonprofit can qualify for the next 80 days at 100% of someone's adjusted gross income. And that's unique. Normally it's only 60% for a cash gift. This year it's 100% through the end of the year. And again, you can also gift funds that are already in a family foundation, in a donor advised fund, or are being held at a company. So these are sources of funds that sometimes people don't think about top of mind, but that's what the money's there for, and it's available for gifting. You can name a favorite nonprofit to an IRA charitable remainder trust, or as the beneficiary of your IRA. As was said earlier, IRAs are not the best assets to leave to family members. So if you do plan on doing some philanthropy, an IRA can be a valuable tool for that. Using an IRA charitable remainder trust combination allows for the kids to get income for a period of time, or a spouse, and then have the proceeds go at the end of that period to a charity of your choosing. We talked about the qualified charitable distributions, and those can be used for outright gifts, but they can also be used over a period of years to create an endowment at a charity. So picture somebody that had more in their IRA than they needed, and they decided for 10 years to give $100,000 a year to charities using their IRA. Over 10 years, that would accumulate to over $1 million, and they could do that in a way where it would build an endowment or fund an endowment at the nonprofit institute. And this can be a great way to not only create good works today, but also build endowments at the nonprofits of your choice. So keep that one in mind. And then again, this idea that if someone is in position to make a major cash gift or wants to accelerate a pledge or what was going to be done through their will or trust, what we call a testamentary gift, you can accelerate that in 2021 and pair it with a Roth conversion. So that's the way, one of the ways to benefit yourself, your family, and charity at the same time. And the charitable lead trust is another great way to do that. Typically, if you're going to give money to charity, you kind of do it year by year, or you make a pledge and you receive a deduction each year as you actually fulfill that pledge. But there's a vehicle for giving called a charitable lead trust. And these are popular with the ultra affluent because it allows you to control the timing of your deduction. You can put money in a trust today, receive a large tax deduction, and then over a period of years, make gifts out to the nonprofits and create both a benefit for your family and for charity. Because as the money comes out of these trusts, it may have grown over the years that you've been holding it, and any growth in those assets that's above and beyond what's given to charity can pass to the family without gift tax. So that's a very interesting vehicle. And with the taxes going up and with limitations on the amount that families can leave to their beneficiaries, to their heirs, becoming more limited, vehicles like this will become more popular as a way of benefiting both family and charity. And then life insurance is another way that you can leverage and endow future gifts to charity. So those were some of the ideas that we talked about and things you can think about before year end. And one of the things we wanted to cover is some of the resources available to you. Emily is a great resource for all of you, and I'd invite you, through your relationships with the Nonprofit Institute to reach out to her. And she has access to the USD planned giving team, and that's provided to anybody that's looking at supporting the Nonprofit Institute. And they can help with some of the more complicated questions. They can run some initial numbers that can provide some guidance and work with a potential donors, advisors, so that they get the information they need, both about the organization, but the benefits of both current gifts, future gifts, or planned gifts. Anna and I are both available if anybody has questions beyond today's Q&A section, which we're going to come up with here, and we'd be glad to help. And then there's great resources within our community. There's an association for fundraising professionals that meets here on a regular basis in San Diego. There's the North County Philanthropy Council and the San Diego Planned Giving Partnership. So if you're interested in learning more, there's great resources here available to you, and feel free to reach out.
Well, thank you so much, John, for that. And I'm just going to share out some of the questions, and Anna and John, you can volley back and forth. So one of the earliest questions we had was, does the 100% AGI deduction apply if the cash gift is made to a donor advised fund?
No, it does not. It has to go directly to a qualified charity. So yes, good question, because that would be great if it did. So clients do think about that, but it has to go directly to a qualified nonprofit.
Wonderful. Thank you for that. And I know that a lot of foundations and other wealth management institutions that hold donor advised funds, they're really encouraging people to give out of those donor advised funds on a regular basis so that the money doesn't get locked up forever.
Yeah.
And it's a good reminder that not only is that applied to the cash gifts, but also the qualified charitable distribution strategy that John mentioned, that's giving out of your IRA if you're over 70.5, that also has to go to a qualified nonprofit. So to your point, Emily, there's definitely a trend of making sure if someone's getting a charitable deduction, it's going directly to an organization.
Well, thanks for that response. And the next question we had was, how does the 5-year carry forward that is available for gifts of appreciated assets factor into the calculation of whether a cash gift is more beneficial this year? And let me know if you want me to read that again.
Want to take that, John, or?
Yeah, I can take that. I actually saw that one early on. Great question. So there's a provision that says if you make all of these different techniques create a deduction. When Anna and I have spoken about the AGI, that's just the speed at which you can use your deductions. And for some individuals, they make very large gifts and they don't have a lot of income. So the IRS has a provision that says if you can't use all of your deductions in the first year, then you can carry it forward for up to 5 additional years. So when we do the analysis, we cover that for the individual that asked the question. We look at how much of the deduction can you use this year, and then will you have enough income in future years to use the balance? And it's part of the analysis we do, part of the reason you want to speak to advisors or have your donors encourage them to speak to their tax advisors, because you may want to control the timing. In some instances, it's advantageous to give sooner, but in some instances, if you're not going to get the benefit of the deductions because you don't have enough adjusted gross income, then you may want to spread those donations out over more years. So that's something to think about. We've been fortunate to work with some really generous people, and sometimes we're actually encouraging them to put the reins on a little bit or spread the giving out. And there are giving techniques that can allow you to do just about anything. A pledge is a good example. Maybe somebody, instead of giving all their money in one year, should spread it out over a number of years, because that will help them get the benefit of the tax savings. And there's a very simple shift as a planned giving officer, or development officer, or even an executive at a nonprofit. Talking to people about the tax benefits isn't a bad thing. It's not a negative thing. It's like it doesn't lessen the value of their giving, because you're encouraging them to get the benefits they're entitled to. And with those benefits, they receive more, their families receive more, and that will leave more for charity. And that's the real purpose we take in trying to educate people about this, both Anna and I, is if you know the rules and you can help donors with the rules, then they can actually give more. It doesn't hurt as much.
Well, thank you for that. One of the things I love about working with Anna and John is they're both very generosity oriented and looking at ways to best facilitate giving, because they're passionate as well about the nonprofit sector. So the next question we had was, can donors convert IRAs to Roths in 2021?
Yes. And I think that question came up early. I hope I did a good job addressing it. But yeah, it is a unique time to do it. And something to keep in mind with this CARE Act, it's the only time in history this has been done where you can get a deduction at 100% of your adjusted gross income. They've only done this in the past for very specific charities, a disaster in Haiti, for example, and you would only get the 100% of AGI type deduction if you gave to that specific calamity, that specific disaster relief fund. This is the only time I'm aware of that you can give to any public charity that's a qualifying nonprofit and get this benefit. It was here last year, it's here this year, it's not planned to go forward. So it's a unique opportunity.
And just to add to that, the Roth conversion limitation that we referenced was a proposal that isn't scheduled to take effect until 2032.
Mm-hmm.
Kind of have as those talking to our donors, we have about 10 years to really be talking about their IRA planning. It's good to keep in mind. There you can absolutely, I think a couple of questions coming in, you can convert as little or as much as you want when you do a Roth conversion. So do keep in that mind. If someone has, $100,000 IRA, they could convert $5,000. They could convert the entire amount. So there are, it's very flexible. I think someone asked and related to that, does it have to happen before the end of the year? It does not. I mean, technically you can convert at any time, but where the end of year timeline is important to donors is because they're planning for a particular tax year. So if they are wanting to do a conversion, and if they're thinking of doing it before the end of the year by choice, they might do exactly what John is saying and saying, gosh, I'm going to take that additional income now. I'm going to take that income tax hit today. Well, how can I reduce that tax pain? I can give to charity. And if I give in cash, as John is highlighting, you can get 100% deduction against that income you just generated by doing that conversion. So that's where the coupling of those strategies is really opportunistic for the nonprofit area.
Thank you, Anna. And there's an interesting thing to think about is it doesn't have to be all of one type or the other. You can give different types of assets, mix cash with appreciated assets, and that might create some opportunities, and it might create some different types of deductions, ones that are subject to 30% limitation, or one that's subject to 100% of AGI opportunity. Or you may still want to support your donor advised fund. And so you'll have a third category there, and they're all good. There's no problems here. It's just trying to optimize things. And there's advisors that are up on this that can help you.
Well, thank you for that. There are a couple other questions. I wasn't sure, Anna, if you were referring to this one when you made your last remarks, but this seems more general. Does the gift need to be transferred before the end of 2021?
Yeah, hopefully, is it Daniel? I hope I answered that, but yes, absolutely. You can, it does not need to be transferred before 2021. It is just more tax year planning. I think because we're kind of in that season. I know I'm seeing this with my clients and the CPAs we work with. You're kind of starting to enter that year-end planning season where donors go to their advisors and say, okay, here's all my taxable income for the year. Here's what I'm thinking of doing charitable wise. And they really start to refine the way they're going to give. That's where the timeline is maybe more specific, but they could do it next year if they wanted to. Absolutely.
Great.
Great. And then I'm not sure if you saw this last one in the chat. It's fairly specific, so maybe you can read it.
I can take that one. Yes, in answer to that, as far as I understand, and we'll let you know if it's any different than this, Patrick, each individual is limited in their QCD to what's in their plan. They're subject to those limitations. So in your example, the first spouse has $50,000 in theirs. They can only do a $50,000 QCD. If the other spouse has $200,000 in their IRA, they would be limited to that $100,000 a year. But what they could do is they could make a gift in December of $100,000, and then in January, do the other $100,000 if they wanted to. And remember that when you make these large gifts, if they're large enough, you can speak to your nonprofit about the potential for endowing a portion of that gift.
Thank you. I know that a lot of nonprofits are looking at diverse forms of revenue streams, and endowments are always a good option to complement, obviously, the immediate cash gifts and other kinds of assets that can provide operating revenues for that year. So are there any other questions that anyone has that they'd like to post in the chat?
I'll just quickly share, if you don't mind, Emily, while we're looking at that, is Patrick, thanks for your question on QCDs. As we chat with the donor community and the nonprofit community, QCDs still seem to be one of the best kept secrets, shockingly. So I would say, if you're in the nonprofit space, you're having conversation with donors, question is this person over 70 and a half? Just, is the person over 70 and a half? If they are, just have the conversation, just to say, I understand that there is a charitable strategy specifically to individuals in your IRAs. And just so the audience knows, as we run these calculations, the qualified charitable distribution tends to be one of the most tax advantageous strategies you can do, period. I mean, period. And there's a lot of reasons why that is. So I would just encourage the audience kind of community just to have those conversations with that right target audience.
Well, thank you so much for that. I know that we did also get a question in the private chat, whether or not this information will be available after this call. We will be sure to have the recording of this webinar available on the Nonprofit Institute's webinar channel, and we will be sending out that link to everyone who registered today, along with, we're very excited, our speakers also said that they would be happy to share the slides. They do need to add some disclosures in the slides, but yes. So with that, again, today is Giving Tuesday for the University of San Diego, and anybody who's so inspired, we would always welcome a contribution to our endowment challenge, and you can see the link in the chat. And of course, anyone that's also so inspired, this is the season to please support any nonprofit out there. Every nonprofit has a really great opportunities for giving right now, and it's a great year for it. So I just want to thank again our speakers, Anna Diaz and John Kraemer. You've been really fabulous, and we're just so honored to have you in our community, and are so grateful to you for all the work that you do to advise people on best ways to give any time of the year. So thanks, everyone. I hope you have a wonderful day.